Welcome to Vision Capital's third quarter 2025 investment outlook. I'm Jeff Schmidt, co-director of investments. During the spring, aggressive U.S. trade policy announced on April 2nd facilitated a rapid 14% fall in the average stock alongside a rise in long-term U.S. interest rates. The subsequent pause of policy implementation announced on April 9th ignited a 24% rise as frameworks and signed agreements followed into midsummer. The UK agreement removes some non-tariff barriers for American goods and sets a permanent base rate at 10%. The Vietnam agreement sets the base rate at 20% with an additional 40% on goods trans-shipped through the country. The extra duty is aimed at Chinese goods with final assembly or production in Vietnam. China has agreed to free up the flow of rare earth magnets to the U.S. in exchange for the removal of certain U.S. tariffs on exports. A 30% base rate on all other imports remains. The Congressional Budget Office estimates that tariffs will generate $2.8 trillion in revenue over the next decade. Ultimate legality remains a critical issue. A federal court ruled that unilateral tariffs are unconstitutional under the Emergency Powers Act, though duties will remain during the appeal. Early evidence of rising U.S. import prices without a spike in consumer inflation implies that U.S. companies are bearing most of the tariff burdens. The expectation is that this will reverse with time and shift the cost to foreign exporters. If not, the burden on the American economy will be split between inflation, employment, and capital. Economic activity remains strong despite a chaotic trade environment. Rates of personal consumption are consistent with previous expansionary periods. Unemployment is low, hiring is steady, and business investment has rebounded. If import prices stop rising or begin to fall, a case for strong economic growth should be argued. If not, this additional tax on the American economy will result in at least a modest loss in output. Any fall in output is also a reduction in tax revenue. The fiscal plague of the 21st century has not been budget deficits. It's been budget deficits during periods of strong economic growth. Before the dot-com era, America averaged a deficit equal to 2.5% of GDP. Post-dot-com, it grew to 4.8%. And in the last 5 years, the deficit has averaged 8.6% of GDP. This causes the U.S. Treasury to sell more new debt each year and refinance maturing debt from prior years. In 2026, the combined amount of debt sales will approach a value equal to 40% of GDP. This future issuance will maintain an upward pressure on long-term interest rates. Three main forces will have a lot to say about how the economy evolves over the next couple of years. Tariff barriers will create more foreign direct investment while at the same time risking inflation, lower corporate profits, and weaker hiring. The AI revolution will result in substantial productivity gains, leading to higher real wages and more personal consumption. But will we be able to retrain and disperse those marginalized out of the workforce without a significant lag? Real GDP will benefit from another fiscal impulse of the One Big Beautiful Bill Act with lower taxes and higher spending. Our baseline is that the net pressure of these forces will be neutral to positive. This is evidenced by us adding risk to portfolios in March and April and shortening the maturity of our bond holdings to reduce our sensitivity to long-term interest rates. Thank you for listening, enjoy the summer, and we look forward to connecting with you again in October.